In this session, we will be preparing another question where we will be preparing a full-fledged single entry statements, and let's look at the question together. A retailer, Miss XYZ, has not kept proper book of accounts. The following information is supplied to you. Prepare the statement to a certain profit or loss for the period and draw up the statement of affairs as on 31st March 2019. They have given us the details, and they've also given us some adjustments. They have asked us to prepare the statement of profit and loss, and they've asked us to prepare the statement of affairs. Please remember, they've not asked us directly to prepare the combined statement of affairs, but we have to prepare the combined statement of affairs because that's a prerequisite for us to go about with the preparation of the statement of profit and loss. So we will be doing that right now. But before we do that, we will be having a quick discussion regarding the items that are mentioned over here. So the very first statement that we will have to be preparing together would be the statement or combined statement of affairs in order to estimate the opening and the closing capital. So let's have the format in place, and let's start off with the combined statement of affairs. So combined statement of affairs, please remember you have to identify which are your assets, which are your liabilities, and the assets that we have here are stock. Okay, so stock, we've considered stock. Then you have creditor, and creditor falls on the liability side. So that has gone in. Then you have then the other items that are given to us, debtors, cash. Please remember uh, these two are your assets. So that has to come in. Then you have bank overdraft. Bank overdraft is a liability. Okay, bank overdraft is a liability, so that goes on the liability side. Then you have bills receivable, furniture, and then delivery van. Bills receivable, furniture, and then delivery van. All this together, this is your. These are your these are your assets. Okay, these are your assets. So with that, we have completed the preparation of the combined statement of affairs. Now let's total up the values. Let's total up the values on the asset side. For the first year, the beginning, it is 46,600. For the end, it is 47,800. So which means your assets liability side total should also be the same, and uh, and let's just quickly calculate, but it is not so you will have to make it the same. And how do we do that? We do that by bringing in the balancing figure. So for the beginning values, the balancing figure is opening capital, and let's just quickly calculate the opening capital now. The opening capital, we will have to take the sum, and that works out to be 11,000 for this end of the time period. The value is the balancing figure will work out to be your closing capital, and closing capital we have considered, we've got that over here, and that works out to be 14,400. So your opening capital is 11,000, closing capital is 14,400. So with that, we have completed the preparation of the combined statement of affairs. The next statement that we have to prepare is your uh, is the statement of profit and loss. Statement of profit and loss, we start off with the closing capital. Closing capital is 14,400. So 14,400 is your closing capital. To this, you have to add drawings. Drawings given to us in the question works out to be 2,600. Okay. Now, 2,600. Do we have additional capital? We do not have additional capital. So when we work out this together, you will get your you will get the adjusted capital, and the adjusted capital works out to be 17,000. Then you from this, you will have to subtract the opening capital. Opening capital is 11,000. So 17,000 minus 11,000, the total works out to be 6,000. The total works out to be 6,000. Now we have to consider all our incomes, and uh, we have to consider all the incomes and gains. Now in this particular question, we do not have any incomes, which means we can proceed directly to the losses. What are the losses that we have? The first loss that we have is depreciation on furniture. So let us consider that depreciation on furniture is charged at 10%. But 10% of what value? 10% of 1500. So 10% of 1500 is 150. Then the next expense that we have is you have to write off rupees 300 for delivery van. So delivery van value written off, this works out to be 300. Okay, this works out to be 300. Next thing that has been told to us is that debtors include 500 from a customer who's insolvent. What is meant by insolvency? Insolvency means he's not in a position to pay the money back. What does this mean? This means that 500 is your bad debt. Okay? 500 is your bad debt. Then, uh, then then they've asked us to create a reserve. They've asked us to create a reserve, and the reserve for bad debt you will have to create at 10%. Sorry, 5%. But 5% of what? 5% of the value of debtor. Okay? Now, how much is debtor? Debtor is 10,500 minus 500. So why is it 10,500 minus 500? What you have to remember over here is uh, what you have to remember here is that debtor, the value is 10,500. But this 10,500 is including bad debts. Okay? It is including bad debts. So the bad debts is included over here, which means effective value of your debtor, okay, effective value of your debtor, okay, that the effective value of your debtor would be 10,500 minus 500, which is rupees. This works out to be rupees 10,000. This works out to be rupees 10,000. So you will have to create 5% on 10,000. You will have to create 5% on 10,000. So that is what is being expected from us. So here, so 5% on 10,000, that amount works out to be 500. Okay, that amount works out to be 500. So with that, we have completed with the preparation of the so are there any more items? No, there are no more items. So now we have to calculate the net, net profit. So how much is net profit? Net profit, we will have to calculate. So what happens is, to the gross profit, you will have to subtract all these amounts, that is depreciation, the delivery van value written off, bad debts, and then reserve for bad debts. So net profit works out to be 4,550. Okay, it works out to be 4,550. Now let's start off with the amount. The opening capital is 11,000. To this you have to add additional capital. You do not have any additional capital. Then we do not have interest on capital. We do not have interest on additional capital. You have to consider the net profit. Net profit has been brought in. Then you have drawings. Drawings is 2,600. Then you have interest on drawings. Interest on drawings, that has also been considered, that has also been factored. So together, your revised closing stock works out to be 12,950. Okay, it works out to be 12,950. Now let us consider the other items. The other items that we have are creditors. Creditors is 14,000. Then you have bank overdraft. Bank overdraft is 19,000. Okay, bank, when you have bank overdraft, okay, so bank overdraft works out to be uh, the bank overdraft works out to be 19,400. So that has been considered. Then we do not have any other liabilities. Now let's move on to the asset side. We still have to factor the adjustments, but that I would be doing eventually in some time. Okay, now let's consider the assets. Now, what are the assets that we have? The assets that we have are stock. Okay, so stock value, the value for stock, we will have to go with the closing values. Closing value is 18,500. Then we have debtor. Debtor's value is 10,500. Now, when we work out for debtors, there are some adjustments that we have to consider. Okay, there are some adjustments that we have to consider. What are the adjustments? The adjustments are bad debts. How much is bad debts? Bad debts is 500. Then you have reserve for bad debts. Okay, then you have reserve for bad debts. Now, reserve for bad debts is 500. So, together, 10,500 minus 500 minus this 500, effective value of your debtors is 9,500. Now, then what are the other items that we have to consider? Then you have cash. Okay, cash. Okay, so cash, we will have to again go with the closing value. Cash's closing value is 1,200. Okay, then we have bills receivable, furniture, delivery van. So let's consider those as well, those items as well. And in this delivery van, there is an adjustment, and the adjustment is we have to consider the value written off. So the delivery van's value is 1,900. From this, you will have to subtract the value written off, and the written off value is 300. So that works out to be 19,000 minus 300. So that is 1,600. Okay, so that is 1,600. And uh, uh, so we still have to consider. Okay, we've considered, I think, pretty much all the amounts. And let me just see if I've missed out on any item. Oh, yes. Thank you so much. I think someone has just dropped me a message saying that I have missed out on the depreciation on the furniture. Yes, thank you for bringing that to my notice. So we will have, I've missed out on on the computation of depreciation on furniture. So depreciation on furniture is 150. So 1,500 minus 150, the effective value is 1,350, and that has been calculated. So the total is 46,350. Okay, so that is 46,350. So with that, we have calculated in total the value of the revised statement of affairs, and with that, we have completed the. And if you notice, the asset is tallying with the liability, which means we've completed our preparation.